In my quest to locate high-yielding dividend investments, I decided to go on a trek to locate the highest-paying dividend ETFs out there using various fund screeners, stock market websites, and just create a list of the highest-yielding dividend ETFs that I could come up with. And so today what I wanted to do was discuss the top 5 funds that I was able to locate that as of the making of this video pay the highest dividends out of all ETFs out there. This list only includes ETFs, so there's no individual stocks, closed-end funds, or exchange-traded notes. But before getting started, there are a couple things to keep in mind. When doing my research for high-yielding dividend ETFs, I realized right away that some of the highest-paying dividend ETFs out there only pay annually or semi-annually. Just as an example, the Direxion Shares ETF Trust, ticker symbol TYD, touts a dividend yield of 10.83%. But when we look at the dividend distribution history for this fund, it only pays an annual dividend. This isn't an ideal situation in terms of living off dividend income, and I personally don't like to invest in annual or semi-annual dividend funds, so for the sake of this list, I decided to leave out these kinds of dividend ETFs, so every fund on this list either pays quarterly or monthly dividends. Another really important thing to consider is the consistency of the dividend distributions of an ETF. To use another example, the ProShares K1 Free Crude Oil Strategy ETF has a high dividend yield and pays dividends quarterly, but when we look at a graph of their payments, we can see a very unusual payout history. It made 4 quarterly dividend payouts this year, but only issued dividends once in 2020, 2018, and 2017. And this situation in particular probably has to do with the performance of oil, so in preparing this list, I only wanted to include funds that have been paying dividends consistently for at least 2 years, ideally every single quarter or month if it's a monthly dividend ETF. Finally, be sure to perform your own research and due diligence before investing. Don't put all your money into one fund, but instead spread it out across multiple investments, which helps reduce risk. If one of your investment reduces its dividend for 1 month or for 1 quarter, you'll have other stocks and funds in your portfolio that you'll be able to rely on. It's also important to not just invest based on dividend yields, but make sure you understand what you're investing in and what the risks are. So with that being said, let's get started. Coming in at number 5 on this list, we have the ProShares Global Listed Private Equity ETF, ticker symbol PEX. This is an exchange-traded fund launched and managed by ProShares advisors that invest in public equity markets around the globe. It seeks to track the performance of the LPX Direct Listed Private Equity Index by using a full replication technique. The fund was first launched back in February of 2013, and it pays a quarterly dividend to shareholders. According to Yahoo Finance, this fund carries a dividend yield of 9.27%. The long-term performance of PEX's share price hasn't exactly been too good. As you can see back in 2013, this ETF is trading at around $40 a share, where it now trades at above $35 a share. However, when we look at the total return for this ETF when dividends were reinvested back into buying more shares of PEX, we can see that since March of 2013, a $10,000 investment into this fund would now have doubled your investment. You now have a total return of 101.73%, which means your original $10,000 would now be $20,164.73. Taking 8 years to double your investment when compared to other investment options out there isn't exactly great, but it just goes to show that sometimes a stock or an ETF can offer such huge dividends that a falling share price doesn't always mean an investment is bad. Another thing to keep in mind though is that this fund is not well diversified at all. As you might have been able to guess by the name of this ETF, this fund invests primarily in private equity, aka financial companies. If we go to the ProShares website, according to this fund's page, approximately 95.27% of what's inside this fund is made up of financial companies. This is a sector that can be hit especially hard when the economy isn't doing so hot, just like back in the 2008 financial crisis. At the same time though, these financials usually offer investors better dividends than other specific sectors. PEX also holds only about 30 companies, which isn't that great either. It does hold a lot of really popular companies and ones that I like to talk about on this channel on a regular basis, like Ares Capital, Main Street Capital, and Prospect Capital among others, but I'd consider 30 holdings to be pretty small. Additionally, this fund's expense ratio is 2.67%, which is much higher than your typical ETF. In fact, it's actually higher than most closed-end funds that I come across, which is pretty unusual to me. Looking at the dividend distribution history for PEX, we can see that it pays quarterly as I mentioned earlier, and it doesn't pay a set amount every single quarter. As you can see by this bar chart, their dividend payouts have varied quite a bit. In December of 2017, they paid $5.85 per share in dividends, but then literally the next quarter, they only paid 3 cents per share. But recently within the last year, they've paid out between 48 cents and $1.28 per share. Needless to say, if you're looking for a dividend ETF in order to live off of consistent income, then PEX probably isn't going to be in your best interest. You can make money from this ETF by reinvesting those dividends, and as long as we're not in a recession, but that high expense ratio is just something that's really turning me off from this fund, and it has a pretty low trading volume too. If you have faith in all the financial companies this fund holds and you're willing to deal with that expense ratio, then this fund might be for you. I'd honestly rather invest in some of these companies individually though, but regardless, this currently is the 5th highest yielding dividend ETF out there at 9.27%. Number 4 on this list is the Global X S&P 500 Covered Call ETF, ticker symbol XYLD. This is an exchange-traded fund that was launched and managed by Global X Management Company that employs a long-short strategy and uses options to create its portfolio and generate dividends. This ETF corresponds to the performance of the SIBO S&P 500 Buy Right Index and was launched back in June of 2013. It pays dividends on a monthly basis, and as of the making of this video, this fund offers investors a dividend yield of 9.58% according to Yahoo Finance. In case you're not too familiar, XYLD is a covered call ETF, which is a fund that follows a buy-right strategy in which the fund buys the stocks in the S&P 500 index and writes or sells corresponding call options on the same index. The ultimate goal of XYLD is to provide investment results that correspond generally to the price and yield performance of the SIBO S&P 500 buy-right index, which as we can see over the years has continued to trend in a positive direction since its inception in 2004. Covered call ETFs are specifically designed to provide investors with ultra-high dividend distributions. XYLD seeks to generate income through covered call writing, which historically produces higher yields in periods of volatility. For more than 8 years, XYLD has continued to pay dividends every month to shareholders. It doesn't pay the same amount because it all depends on the performance of the SIBO S&P 500 Buy Right Index, but its dividend yield has generally hovered around 8 to 10% for quite a while now. If we look at the top holdings for this fund, we can see that it covers all the popular S&P 500 stocks. Apple and Microsoft make up the largest percentage, followed by Amazon, Google, Tesla, and Meta. In total, there's about 509 different holdings in this fund. Again, it pretty well patterns the S&P 500 Buy Right Index. If we take a deeper look, we can see technology companies make up the largest percentage, followed by financials and consumer cyclicals. In case you were wondering, consumer cyclicals are companies that tend to do well during good economic times, like cars and luxury brands, whereas non-cyclicals are stocks that tend to do better during harder economic times, like household cleaning products, utilities, and basic food items like soup. Out of all the covered call ETFs out there, this one is probably the least popular one, at least out of the funds that use a pure covered call strategy. Some ETFs like XYLD use covered calls, but they only write call options on half of its holdings. The reason for this is that so people who want to focus more on price growth as opposed to dividend yields have their own option. XYLD's dividend is only about half of what XYLD offers, but it's still a good investment too if you want more growth. Additionally, XYLD's share price is currently up almost 10% from a year ago, which is really good. Now at number 3, we have the Global X Russell 2000 Covered Call ETF, which is ticker symbol RYLD. This is an ETF launched and managed by Global X that employs a long-short strategy and uses options to create its portfolio and generate dividends. This ETF corresponds to the performance of the SIBO Russell 2000 Buy Right Index. It's a newer fund being just launched a little over 2 years ago in 2019, and it also pays dividends on a monthly basis and currently offers investors a dividend yield of 11.11% according to Yahoo Finance. This fund is pretty similar to the S&P 500 covered call ETF that we just covered, where it follows a covered call or buy right strategy in which the fund buys exposure to the stocks in the Russell 2000 index and writes or sells corresponding call options on the same index. According to Global X's website, it seeks to generate income through covered call writing, which historically produces higher yields in periods of volatility. I won't go into too much detail on how this fund works since it's pretty much identical to XYLD. It has, however, been able to offer investors a bit higher of a dividend yield too at 11.11% compared to XYLD's 9.58%. It still pays dividends monthly too, as I just mentioned, with their last being for a little over 25 cents a share. If we look at the holdings for this fund, we can see that it only holds one thing, and that's the Vanguard Russell 2000 ETF. So if we look inside that, we can see that it's well diversified across the Russell 2000 index. According to Vanguard's website, it holds 2,088 holdings, with AMC being their largest holding, which I thought was kind of interesting. Then there's also Avis, Crocs, Macy's, and some other companies in the index. This fund is also better diversified in terms of different sectors, with healthcare being the largest sector at 17.6%, followed by financials at 15.8%, and then industrials at 15.2%, and so on. It's also worth mentioning that both RYLD and XYLD have the same expense ratio at 0.6%, which my opinion isn't too bad, but considering both of these covered call funds are index funds, it is a bit higher than average. But considering that this fund basically writes the covered calls for you, I really don't have too big of a concern for it. It's significantly cheaper than most closed-end funds, and they both offer higher dividend yields than most closed-end funds anyways. In conclusion, RYLD is probably the second most popular covered call ETF out there, at least from what I've seen. A lot of people, including myself, love the sky-high dividends that these funds provide, and even though other fund companies have started introducing their own covered call ETFs, Global X's funds still continue to dominate the sector. Even though there isn't much growth with RYLD, if you reinvest the dividends, you'll still come out on top with some good gains from this ETF, but it's up over 7% from a year ago without reinvesting dividends, which is good. Now, coming in at number 2 is a fund that if you regularly watch my channel, you'll probably be well aware of, and that's the Global X Nasdaq 100 Covered Call ETF, ticker symbol QYLD. This is also the last covered call ETF on this list in case you were curious, but this is an exchange-traded fund that uses a covered call strategy in order to generate high dividends to shareholders. It corresponds to the performance of the SIBO Nasdaq 100 Buy Right V2 index, and it was launched back in December of 2013. With a dividend yield of 11.8%, QYLD was really the motivation for people to create their own investing group called QYLD Gang on Reddit, which I guess could be described as a movement where people are allocating sizable amounts of their portfolios into covered call ETFs like QYLD, RYLD, XYLD, as well as some other Global X funds like QYLG. For people who are really serious about investing in covered call ETFs, some like to use what's known as the quadfecta portfolio. This strategy has investors placing their money into 4 different funds equally, with 25% for QYLD, 25% for JEPI, 25% for NUSI, and 25% for a fund called DIVO, which helps in terms of portfolio growth. Whether or not you choose to pursue a strategy with a lot of covered call funds, it is important to make sure that some of your portfolio is allocated towards growth. One fund I'd also recommend would be SCHD, which is a dividend growth ETF. But people who are looking for consistent monthly income have a lot to like about QYLD, as well as the other covered call ETFs we've looked at. Since its inception in late 2013, QYLD has been able to consistently pay around 15 cents to 20 cents per month. While share price performance for QYLD hasn't been as good as RYLD and XYLD, the dividends that QYLD pays makes up for that when we run the numbers. As you can see, a $10,000 investment 5 years ago would still leave you with a sizable return on your investment. If you really want more information on this philosophy of dividend investing, I'd suggest taking a look around the QYLD Gang subreddit. You'll find a lot of people who are really passionate about this fund, and you can read why people are choosing to invest heavily in these kinds of ETFs. It holds a lot of popular Nasdaq 100 companies, including Apple, Microsoft, and Amazon. Overall, QYLD continues to be the highest yielding covered call ETF out there. Before continuing, if this video has provided you with any sort of benefit, I'd really appreciate it if you could give this video a thumbs up, and also feel free to subscribe to the channel for more content. Dividend Bull revolves around dividend and income investing with a focus on trying to locate safer, higher yielding investments. So if you'd like to see more content, please feel free to let me know by commenting below and give this video a thumbs up. Thanks again so much for your consideration, as well as your continual support and for watching this far. Finally, the number 1 highest yielding dividend ETF is the Mutaris US Equity Cumulative Dividend Fund Series 2027 ETF, ticker symbol IDiv. This is an exchange-traded fund that seeks to provide monthly payments that before fees and expenses replicates the actual dividends paid by the S&P 500 without price exposure, as represented by the Mutaris US Cumulative Dividends Index Series 2027. It was launched back in 2018 and currently offers a massive dividend yield of 13.65%. IDiv is a really unusual kind of ETF in that it's a dividend futures ETF, which means the returns this fund gets are strongly dependent on dividend growth rates within the S&P 500. It does pay a monthly dividend, and as we can see by this chart, dividends have been pretty consistent since this fund's inception in 2018, delivering anywhere between 5 cents and 15 cents per share per month. Despite that though, there's a number of issues that I think are worth taking a look at. For one thing, we can see right away that the share price of this fund has continued on a downward trend since being launched. It's actually down a little over 4% from this time a year ago, and as you can see, the fund recently had a really sizable plunge back in March of this year. I'm not entirely sure why this was the case, but it really did kind of speed up the decline of this fund's total performance. And just running the total return numbers when we reinvest dividends, you really wouldn't be looking at great results if you chose to make a $10,000 investment back when this ETF was first getting started. Another thing worth considering is that year in this fund's title, 2027. This is when the fund expires and will cease to exist, so this isn't going to be a long-term investment. On top of that, it has an expense ratio of 0.87%, which isn't awful, but it's still one of the highest expense ratios on this list. Needless to say, there's a lot that I really don't like about this fund. It's possible to earn positive returns if you happen to buy in at a really good time, but I really don't know who would really like this fund except for maybe speculative investors. If you can't hold it past 2027, you can't exactly retire and live off of it. Plus, since dividend growth in the S&P 500 remains stable, I don't expect the dividends to grow. You can obviously come to your own conclusions, but I really don't like where this fund is going, and I don't think it's worth the huge dividend payments. And that's going to be the conclusion of our list. There's definitely some funds here that in my opinion are better than others, but be sure to do your own research before investing. Higher yields generally mean higher risks, so make sure you understand what you're investing in and to diversify your portfolios. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching and I'll catch you next time. Take care.